Hey, fellow traders. Hello, all new viewers, and welcome back, fellow subscribers. I appreciate all the support. Getting a little tongue-tied already in the beginning. If it's your first time to the channel, make sure you subscribe and hit the bell for new notifications. I'm constantly uploading new videos, doing lives, and just looking for questions to answer from you guys. Today, in this video, I'm gonna go ahead and cover something that I kind of newly discovered by accident. Basically, what we're gonna take a look at today is what happened because mistakes were definitely made, money was definitely lost, but because I was able to remain calm and kind of pay attention, I noticed something and I made quite a discovery. So basically, what I'm going to be looking at is I'm going to take a look at one thing first as a baseline. I'm going to take a look at the mechanics and the reasonings behind a commonly accepted idea. And then I'm going to kind of break it down and look at how all of that works together, what's actually doing the work, what's kind of part of that structure and strategy. And then I'm going to reintegrate that into an offensive idea. Basically, kind of what I've worked out is uh, basically a way to where I can go and over leverage, but do it in a safe way. But first, before I talk about what I'm actually going to be, or how I'm actually going to be accomplishing that, I'm going to first take a look at a common idea. And normally, this might be referred to as a martingale, or it's more commonly known as an average in. But basically, we're going to say that, for example, you were looking for a reversal in price. It came down, it kind of rejected, and you bought right here. And you added in down here because you still feel like the idea is still valid and the idea could still work, and it also increases your position size. Now, this naturally has a good risk management way because what's happening now is you have your risk kind of more evenly balanced between the two. You have this small position, we'll say this is like a 0.1, and this is like, say for example, 30 pips to this stop zone that you're looking to cut your trade at, and then you're looking to add in another 0.1 for a total of 0.2 lots altogether. And this right here, let's say this is about 10 pips to this distance. So if you're using a USD account, you're looking at this being $10 of risk and this being $30 of risk. For a 0.2, you have a grand total of $40 of risk. So what's going on in this situation is you're kind of taking a little bit of the shock out of the risk, but now a lot of times what's going to happen is you now have a break-even point right here in the middle, and this is the natural reasoning of why you would want to apply this. Say for example the market's kind of stalling, at least nothing else, you can cut it around this area and kind of get out even though price never came back and cleared over our original position. So what I'm actually looking at, and I kind of happened to notice this by just doing things a little bit too aggressively last night and during the London session on a different account, and I kind of lost a little bit of money by making those mistakes. Of course, the market will penalize you if you are not doing things correctly or you're not paying attention, you're not experienced, in a number of different reasons. Uh, especially if you're scalping or speed trading or looking to make quick in and outs, looking away for just a few seconds even could be quite harmful. So there's a lot of different pitfalls. But I know the major pitfall with that type of setup is if you're wrong, you're ultimately double wrong, and it kind of hurts the equity in the long run. But now I've also been taking a look at adding in as you raise up. Like, say, for example, you get this right here and you enter, price starts to go up, it retraces, and then it goes up more, and you want to actually add more in. So we'll use the same examples with 0.1 for each one. And then, so that's a total of 0.2. And let's say, for example, you had a stop down here. So now you do have a larger risk, and this is what a lot of people are initially looking at first. So now, you know, you have your initial stop area, we'll say it's 20 pips. And now this area and distance here is, let's say, another 8 pips higher. So now the total for this area is now 28 pips. So this is significantly larger. But what I'm looking at actually applying is previously, before I was looking at, looking at a larger stop, for example, using like a 20 pip stop, and then cutting it short of that, thus risking and losing a lot less if we're wrong. I'm looking to actually apply that same logic to this position. So let's say price is coming along. I'm going to get some of this out of the way so it doesn't get confusing. But let's get rid of these as well. Get rid of that. And we're just going to ignore those distances for a second and only focus on the fact that this distance right here between these two positions has to be greater than 4 pips. 3 will work sometimes if it's a little slow, but you really want it to be greater than 4 pips. And this is one of those situations where you're adding in because you're right and the market continues to move in your favor. And now, instead of looking at, okay, we have all of this risk involved, here's what we're going to do with this situation. We're going to modify things a little bit to look at our risk differently. So in the ideal situation, of course, we go sky high and shoot to the moon, and then now we get double of our position and gain. But let's say that starts to happen, and then all of a sudden price just kind of fizzles out a little bit. It doesn't want to go anymore, and now all of a sudden it's looking like it's starting to come back down. Well, here's what we're going to actually take advantage of, the defensive part of this situation. And this is the advantage part of how you can try to use this as an offensive technique to over leverage, but not actually put significant amount of risk on the account. So what you're going to do in this situation is, now you're not too sure, we're going to go ahead and close the bottom position. Now what just happened there is we had a gain, and now we can leave this position here, and if, let's say, it does take off, well, now we just got this gain plus that gain, but we didn't get our double gain. But if this does start to come back, now we can actually come back to this level if we want and close this position at break even, or we can close it up here taking a small gain. And that actually kind of takes advantage of a few different things. So with that said, it is a fairly technical type of application. It could happen quickly, it could be, but it's definitely going to be one of those situations where you're sitting in front of the computer. But let's go ahead and take a look at how that can be applied, because I understand that is possibly going to be confusing, but it does have a few different options. So what I'm going to do is, of course, cherry pick something that's going to work, but it's going to be designed to show exactly the whole mechanics and principle of it. So basically, we started with that idea that we had our, of course, break even and our average in to get our break even point lower as a defensive point. And now basically what I'm doing with this is to raise the break-even point higher and work with the positions individually, kind of like a team, as one supporting the other, to actually protect the backside of the averaged in or the added in position. So let's see if we can have a good example here. So let's take, this is just going to be something pretty simple, but we know the price is going up, so we're going to look at an ideal situation first. So let's say, for example, we're looking to go long. It looks like we're getting that curve up, going long, yada yada, whatever reason you're looking at. And then we're going to put our stop loss down below. Use about 30, that'll be about 15 pips or so, because we're using a 0.02 in this example because that's what's set up. But now, as price begins to move forward and starts to clearly move in our favor, let's get it there. So now things are looking up and things are looking pretty good. We're above the support. So now we're going to average in. We're at least 4 pips above this point. So we buy in another point, and it's not going to exactly show it too well with that. Kind of forgot about that. So we'll use these little tools here to represent our actual entries and put them together. Now, I'm going to put this down here, but that is not where we're closing the trade. The same goes for the initial position. This is our ideal outcome. We're looking for price to just go that way and take what we can get out of it. So, it's looking kind of funny. But as price goes, of course, we know this one will represent a doubled up gain. And we'll have to find another equal position where it's starting to go against us. So we're still holding up and looking good there, so we decided to hold. And of course, our equity is rising at the double rate. But now we have that gain realized with our double risk, and we would obviously be bringing our stops up as this goes. So we would take that off. That would be an ideal situation. So now, let's say when things are going wrong, let's go back and find something that might kind of work. Let's try this example here. We will go right there. All right, now we'll try this as a sell example and look at what's going to happen when it fails. So let's get a little closer so we can get what's going on. Don't want to be too far away. And we will say, for example, we're taking our setup. Okay, so we got that break across. We're feeling pretty confident that this is going to continue short, so we're going to take our entry. Okay, and then we are going to sell just to use that as the account reference of equity and loss and gain. I don't think it'll really help much. Actually, yes, I think it might, because we have the first in, first out rule applied. So now we're going to let price go. And okay, it really went in our favor, probably a little further than I would have liked. Let's take it back to right. Go back one more. And then we're just not going to worry about that. So now we have that, and we're just going to add in an additional one for short. Ignoring that, we're going to be closing this differently. I'm going to show you how to handle this to where we don't worry about any of this here. That's just for the sake of keeping one in play, general practice, passing a challenge, so on and so forth. And we're also not concerned too much with the targets. So let's go ahead and creep this forward and say, all right, it's kind of going, but now all of a sudden it's starting to come back against us. So now what we would do is, of course, we would take the first one, our first entry, close it. So we now have 4 pips of gain. Even if we're using 0.1, that would be $4. And now we have this one in loss of 1 pip. We could already go ahead and close this and take our small gain here And if it we're not sure if that's even going to continue or not, we could even let this go all the way to right in this little zone right in here and still be plenty safe with what we had in regards to looking at our risk. And I hit the wrong button. See if we can get back there to the right spot. So see, now at that point it would be a bad situation because I hit the wrong button. I was trying to show it, but even still, closing it there, it's a little bit worse than that break-even position. I'll leave it right there. And then we now have an equal loss and an equal gain. But now, because we closed this one out first and let that one ride, because maybe it still could have gone, we could have probably got a little bit more out of that position and closed it. Or even worst case scenario, if it starts to come back, we close it out here and we only lose a small amount of commission. So the idea is to try to get this right, add in more once you are certain and have more confidence that you are correct. But then if the market starts to come against you, like it didn't quite break this high here and started coming back, and then especially there it started breaking. For example, we'll use our first entry. So you could even close out both positions here and end up in a spot where you have some room to work. The idea is to leave yourself enough room for price to work, but if things are getting a little shaky, your confidence is sinking, always close the first entry first, which works with the first in, first out rules of the United States if you're trading that way with USA regulation, and then you close out your second, wherever that winds up being, but definitely before it reaches the point of where the first entry is. So that's kind of the idea. It kind of wastes the opportunity of a trade because, for example, instead of taking the full gain of just the one entry, you took a little bit more risk and kept it protected with the first position. So that first entry kind of acts as a utility position to protect the backside of averaging in. And if you get it correct, you get double gain. But if you get it wrong and need to back out of it, you lose nothing or close to nothing. And that's the entire idea of trying to give this little bit of space between the two areas. And that little bit of space is what will be able to create this situation as the outcome. Either you get the double gain or you lose nothing or next to nothing or even make a small little gain. So just try to keep that in mind and definitely give this some practice because, of course, with the last setup that we kind of took a look at in the beginning when we were opening up at the video and looking at the principles and ideas, of course, if you are double wrong, it can double hurt. So just like using some of the latest techniques in the other videos, if you are not comfortable with definitely getting out, if you're not good at identifying good places to enter trades to control risk, or any of those type of difficulties along those lines, especially if you're just taking random entries. If you're jumping in here, for example, you're probably not going to have a very tight risk control. Disregard the distance is not to scale. But you jump in up here and you have to cover this low. It's a lot better than waiting for price to retrace or trying to get it on the initial breakout, because now your distance is cut in half, which cuts your risk amount down significantly to where you can use either a larger size, a lower risk amount, and get a higher R ratio to recover back some of those losses that you may have incurred up to this point where you possibly got it right. So just keep that in mind when you're looking for entries. It's not really so much about a direct signal. It's a lot of times about having a good position to where you can structure your risk to where you have a clear invalidation point near the entry, because the farther you are away from a possible invalidation point, the more likely you are to be wrong and lose significantly more than waiting for price to get closer to that invalidation point and then trying to take that same entry. It will work double fold in a positive way, just by adding a little patience sometimes and using that risk control method of trying to get as close as possible and be as patient as possible for an entry off of an area where you can potentially cover that low, still give some room, and leave room for invalidation to where you can close it early, whereas trying to expand your whole zone of risk just to cover this low. So you don't want this to be 30 pips when you can get down here and cover 30 pips and have your mark down here, for example. So that's going to be how you can have a much better representation of your risk. So if you took entry up here, hoping for that, and you take this distance, but then you look at that distance, if you took an entry here, for example, you can see that your chance of success and your amount of risk, because there you got tagged out, you jumped in, you got impatient, but if you waited, you can still have that same size of risk, take the entry here, and get a much better entry, much better risk control. So that's just an example of where you would get that situation. And then, for example, like on this chart, you could take your double down entry or your add-in entry there, and then basically this entire zone here you have to work with if price should start to retrace against you or whatever. That halfway point is your break even. So if you go a little bit larger, that of course is going to raise your break even point, so you would have to close sooner. If you're using, I would recommend no more than 150% in size as the beginning one. So if you're trading a 0.01 here, or a 0.1 there, for example, 10 of the 0.01s, then I would not do any more than 0.15 here, because the larger that is, the closer this break-even point gets to that second position. You want to try to keep that as close to the center, no more than 2/3 of the way up, hence that 150% difference in size. This way you leave some room to be wrong and come back. So like, let's say you had a trend line there and it started to come back and then it started to break and pin below. Well, now you've got this entire zone here. So we'll take, for example, let me get this out of the way to kind of demonstrate that a little bit. So this is our break-even point there on that line, and let's say price starts to retrace. We take our entry there, it goes up a little bit, and now it closes, it breaks, it closes below. You can close out both positions together, and you can actually make a small gain off of that. When you didn't quite get it right, it didn't quite explode out of there. You want to try to use this sparingly though, because it's double hurt if you go below that break-even point and start coming below, especially if you actually come below your initial entry. You definitely do not want to have both of these open and price going below your initial entry, because that is really going to hurt. So make sure you are definitely okay with getting out as easy as you are getting in. So that's kind of one way to kind of put at it and address it. And one other little tip, if when it comes to raising the leverage, if you are starting to get excited after the trade is open, it's very likely that you are risking too much. You still want to be conservative while doing this because of this double hurt. But as long as you're taking precaution and looking and getting solid entries, you have a lot of practice with what your trading strategy is, you'll have a lot higher chance of success versus someone who just jumps into the chart, doesn't have a lot of experience trading, and just starts throwing down entries. You'll have 5, 6, 7 entries, and then all of a sudden now price is down here. All of these are no good, and you just lost half the account. So that's something to be very careful with. You do not want to consistently add up and stack up. I wouldn't recommend doing this more than just doing one additional add-in, because of course the more price travels away from that initial entry and the other add-ins, the higher price goes and you add in, the higher your break-even point goes, and thus the lower the amount of room left for price to come back and you actually make a profit. So if you have, like say you entered here, then you entered here, and then price kind of goes up, and now you enter here, and then goes up, and then you enter here. Well, now when price does decide to retrace, before, where on your initial entry your break even point was here, now with all of these entries your break even point is way up here. So should price have a quick drop, a snapback, like if you're trading the JPY and it just has a snapback where it just kind of goes back down real fast, well, now this entire area between here and here is loss. Whereas if you did not average in multiple times on the way up, you don't incur loss until way down here. So this entire drop could still be profitable all the way down here. So you want to be very careful about sending way too many positions in there. I recommend keeping it to 2, a maximum of 3, and try to keep them about 4 to 6 pips apart. You want to keep them fairly close to keep that break even point from getting way too high. Because if it ends up getting too high, you take this as a loss instead of only taking that much as a loss. So that makes quite a significant difference overall. And then this is going to be quadrupled versus this only being doubled. So it's going to make a significant impact on the account if you consistently stack in repeatedly on a long drive. It's very rare as well to keep in mind. It's very rare. The longer a trend goes, the more likely it is to continue. So that also puts these higher up positions in a greater danger of actually making a loss instead of working to your benefit. So just a couple of things to look out for when using this, because like I say, it is a little bit technical. It requires quick thinking a little bit of times, especially trying to catch some of the news events or major impact events. So I'll have to set this up on the Forex testing software and run an actual example there, because it would allow the separation of positions. But that should give a general idea of a fairly safe method of trying to actually over leverage but not actually put a lot of risk or jeopardy on the account. Just keep in mind, you take your first position, price begins to actually move in your favor. You don't want to do this when it's moving out of your favor, but when it's moving in your favor, then you go and you add in another position above it. Keep in mind, this has to be 4 pips or more. Your break-even point is now going to be in the center. Your stop can still be fairly low, and if price goes and then starts to come back a little bit, make sure you're closing the first bottom position, first entry first, and then give this one a chance. If it's not going to work, then you have this entire area to decide whether or not you want to take it out or leave it. So it's all about the risk management first. And if price does continue to take off, then of course you can add another one in as it's breaking up and try the procedure again. And the whole while, until you get it right, this will kind of keep your equity curve kind of going like this, a little bit flat. And then when you get one, it's going to go like that. But just keep in mind, this is a little bit dangerous, a little bit advanced. So, you don't want to have a hot dog if you don't want to eat a hot dog. Sorry, goofing around a little bit. But basically, this is the ideal outcome, but you want to be careful, because just like it can go up, it can go down if you're not careful. That's one thing. That's the number one thing I always emphasize with risk. A lot of people do love and tend to focus on those gains. You have to risk the same amount, the same degree of risk is required for a certain degree of gain. So if you're looking for $100 of gain and you're only working with a 3 or a 4 to 1, you're going to have to risk $20, $25, $30, $33. So if you want to make the money, you have to risk the money. So always remember, just because it can go up that fast, it can also plummet just as fast. So that's something to always watch out for. So be careful. Make sure you try this and practice a few times. Pay attention to the way that you're looking with your account, your equity, your risk management. You have to have all these things in check. If you want a great testing software that's really good at cost tracking, good at tracking all your swaps, your fees, your commissions, even spread if you need it. All of this can be fully customized. I'll leave a link for that software down below in the description. Just make sure you practice, practice, practice. It's something a lot of traders do not want to do because it's dull and boring, but it pays dividends in the long run, especially when you're working with new ideas. But that is the general theory and use and application of this type of thinking, and it kind of happened due to a mistake. And I wound up doing this type of setup 4 different times. It succeeded twice, and then I didn't quite have everything figured out fully yet, and I kind of lost a little bit also doing that. So I kind of reverted back to a lower risk and stopped doing that. And I would also recommend capping this at probably about 2 to 3% risk maximum. So if you're looking to risk a high amount with higher leverage, would recommend capping that at about 3% or so maximum between total positions. And definitely try to imply uh, entering at somewhere you can control your risk. Like, for example, here you're fairly close, whereas if price does decide to shoot back up, which would give you your confirmation, well, now your actual invalidation zone and loss zone is almost twice as much. So uh, that's one of the sacrifices you have to make for confirmation. So just keep that in mind and try to catch areas where it's kind of clear price is reversed and is likely to do it again. That's probably one of the easiest ways to try to find good spots to enter a trade with a short distance of stop. Right now it's in Tokyo session. It doesn't look like we're going to be doing too much. You don't really want to take a whole lot of trades right now either, I would recommend, because we do not have very much by way of distance going on. We're only working at about a 10 pip range since we jumped up here over the open of the day. So uh, definitely be careful out this year. It does look like we're being rather sluggish in the market in several areas. We just had some major news and nothing really happened other than the 100 pip drop on most pairs. But just be careful, especially using this technique in a slower market, because you could get faked out quite a bit as well. So one other little pitfall to look out for. But I think I'm going to wrap this video up, and I will see you guys in the next one. I know I'm also planning to do some more lives coming up. Start a new 5K account, and I'm working on a free course basically that I'm going to post as I create each segment. I'm just going to upload it to a playlist, so be on the lookout for that as well if it's not up already. And if it is up, be sure to head over and check that out. It'll give you a full start to finish. If you've never really traded anything before, all the way up to becoming a knowledgeable uh, person of the market. No guarantees, of course, can be made. No results are typical, but I will do my best to try to teach and help as many as I can, just because it's enjoyable for me and I just enjoy talking about trading. So, what better than to talk about it with others who share the same interest, passion, and goals? So, let's join up on some live streams sometimes and hang out and bring your questions, and let's just talk about some tradings and trader talks. And I'll see you in the next video.